Hello, I'm Bernard Hickey from interest.co.nz and welcome to a special report on our favourite things, interest rates, brought to you in association with ASB. Today we're going to look at how quickly interest rates are falling. This is all because everyone in the market is expecting the official cash rate to be cut by a full 100 basis points on December the 4th. That's when the Reserve Bank has its regular rate setting announcement. The economy is slowing very fast, both here and in the rest of the world. And the Reserve Bank is seeing low inflation ahead of it. It has plenty of room, it believes, to cut the official cash rate to try and boost the economy and get things going again. So most people are expecting the Reserve Bank to cut the official cash rate from 6.5% to 5.5%. In fact, over the next 6 months, economists are saying that official cash rate could be cut as low as 4%. We even have one economist saying 3.25%. So what does that mean for mortgage rates and term deposit rates? Firstly, mortgage rates. Variable rates are likely to fall as low as 6 to 7% in the next 6 months or so, as it follows down the official cash rate. The big question will be, will fixed mortgage rates follow the official cash rate as far down? Let's have a look at what's happened in the last week or so, just to give us an idea of where things are headed. Earlier this week, Kiwibank and Westpac both cut their variable rates significantly. And today we've seen ASB, BNZ and others cut their variable rates quite significantly. Kiwibank's currently at 7.95%. The big banks are around about 8.7%. Meanwhile, all of their 2-year fixed rates are down at about 7.6%. Now, we're all used over the last 3 or 4 years to fixed rates being significantly lower than variable rates. And that's why New Zealanders love fixed rate mortgages. Frankly, they're cheaper. And for a long time, they've been quite a lot cheaper than variable rates. That may be about to change. We are seeing now the banks significantly slash their variable rates, and the gap is beginning to close between fixed rates and variable rates. It certainly makes sense for mortgage borrowers to be fixing short to take advantage of these low interest rates as they fall. We may see in the next year or so people choosing variable rates simply because they're cheaper than fixed rates. That will be an interesting change, not just for the market, but for monetary policy as well. It will change the Reserve Bank from having a monetary policy tool, which is a bit like a drip feed to the leg, to having a monetary policy tool that is a hypodermic needle to the jugular vein. It will be able to change monetary policy and have that affect people's household disposable income almost immediately. It hasn't had that for the last couple of years and has been a factor, some say, in its problems in moving the economy around quickly. What does this all mean then for those people who are on mortgages and who have term deposits that they're rolling over? Certainly go short if you've got a mortgage. Interest rates are falling and falling fast. Savers, however, should try to preserve those high rates for as long as possible, which means fixing for as long as possible. I'm Bernard Hickey. That was a special report on interest rates, brought to you in association with ASB.